Oh, hi, everybody. So sorry I'm late. I'm late. And please forgive me. So I guess we're up to what, chapter 4 now in our class?
Yes.
Okay, so let me get the old PowerPoints going and let me move where you can see me. There we go. There am I. Now let's get into chapter 4. And let me get my thumb drive. Okay, we have a pretty good group here today. Let's see if I can get into the PowerPoints. Come up over here. Let me get into the right classroom. Had a tough morning here, so I'm just getting into gear. Okay, coming up. All right. This thing is giving me a hard time. Share the screen. Share. Come on, share. Do you see the PowerPoints now?
Yes.
Okay, I guess we're ready to roll. We are ready to roll. Let me move this out of the way. Okay. Okay. We're going to talk about the accrual basis of accounting. The accrual basis. That's the only basis we teach. That is GAAP, the accrual basis, okay? And after we discuss that, we're going to go into adjusting journal entries. What you're going to learn is that the trial balance that we prepare at the end of the month, by definition, is wrong. How about that? The month ended. We had 30 days of recording transactions. The month ends, and now we find out we have to adjust an incorrect trial balance. And then we're going to prepare an adjusted trial balance and some closing entries. Okay, so this can be a little bit tricky. So let's attack it here logically and effectively. Explain the accrual basis of accounting. We divide a business into months. Okay, months or quarters or years. And we want to make sure that the sales that took place in a particular month are recorded there. And we want to make sure that the expenses that were incurred during that month are recorded there. Okay. Accrual basis accounting basically comes down to you record sales when they take place, not when the cash changes hands, and expenses the same thing. Now here they're talking about this crazy word periodicity. That's a word I don't think I've ever used in a sentence other than in a classroom. It just means that we can break down a business into monthly parts and analyze it, okay? So periodicity, that is a gap principle that perhaps you might get on the test in a multiple choice question. Accrual basis, periodicity. Companies recognize revenue when the services are performed or when the sale is made. And this is all an attempt to match revenues and expenses. There's a matching principle. The matching principle matches revenues and expenses. And under this periodicity term, the economic life of a business can be divided into, they're calling them artificial time periods, months, quarters, years. My goodness, D is totally wrong. The fiscal year should correspond with the calendar year. That is 100% wrong. The fiscal year can be whatever 12 months you choose. I don't know how that could have got past the censor. Oh, okay, that was the question. What is the periodicity assumption? The economic life of the business can be divided into artificial time periods, okay? Revenue recognition. Revenue recognition. You recognize revenue in the accounting period in which you perform the service. The customer requests service, cash received. Revenue should be recognized when you did the job, when you shipped the product or performed the service. Revenue recognition. A contract is an agreement between two parties. Sierra has contact with Lewis to provide guide services. Identify the separate performance obligations. Sierra has one obligation here. They're making this much too complicated, by the way. Sierra Lewis provides guide services. They will recognize the revenue when they provide the services, okay? They have just one obligation, provide guide services to the Lewis family. And now you recognize when they perform the service, all right? That is a key element of when you record your revenues. Same thing with expenses. You recognize expenses when they are incurred. For example, at the end of the month, you worked a few hours, you worked 3 or 4 days on your job, the last 3 days of the month. You earned $300 those 3 days. You did that August 29th, 30th, and 31st. Those 3 days of expense belong in August, even though you are not going to be paid for another couple of weeks. That's an example of the expense going into the correct fiscal period. And we're back to this periodicity. These are just principles that we just kind of went over. Periodicity, you break the business up into segments. Revenue recognition principle, when it happens. Same thing with expense, when it happens. Which of the following statements about the accrual basis of accounting is false? Events that, let's just skip ahead and get to it. Revenue is recorded only when cash is received and expense only when, no. Cash has nothing to do with when you record the revenue, okay? Events that change a company's fiscal financial statements are recorded when they occur. Yes. Revenue is recognized in the period when the services are rendered. Yes. This basis is in accordance with GAAP. Yes. Accrual versus cash accounting. Now, I'm not going to talk about cash basis accounting at all. We're going to skip any reference to cash basis accounting. Cash basis accounting is not GAAP. It is not an acceptable way to prepare financial statements. And frankly, if you have a fairly large company and you're running it on a cash basis accounting method, you're going to cash basis yourself out of business because you're not going to really know what your profitabilities are, what your exposures are. Accrual-based accounting, transactions occur recorded when they occur. And I think we've been over that a bunch of times. Companies recognize revenue when they perform the service, regardless of the cash. Expenses are recognized when incurred. Has nothing to do with when you get paid. That's GAAP. I'm going to skip cash basis accounting other than to tell you that cash basis accounting, you record everything when the cash changes hands. So we're going to disregard these two slides here about cash basis. I guarantee you're not going to get any questions on those. Now, we run a trial balance at the end of the month, right? And that trial balance shows us that the debits equal the credits. But by definition, that trial balance is incorrect because it's not complete. There are certain entries that can only be done at the end of the month. And let's talk about those. Need for adjusting entries to ensure that revenue recognition and expense recognition principles are followed. That's why we do these adjusting entries. They're necessary because the trial balance may not contain up-to-date and complete data required every time a company prepares their financial statements. And every single adjusting entry will include one income statement account, one balance sheet account, and you will never, ever adjust cash. You will never see an adjustment to cash. So don't make that mistake. Adjusting entries, they're made to ensure that revenues and expenses are recognized in the period when they incur. Revenues are recorded in the period in which services are rendered. You notice they're pounding that into our skull? Balance sheet and income statement accounts have correct balances at the end of the month. That's the goal we're going for. So all of the responses are correct. Now let's talk about two different types of adjusting entries, okay? Prepaid expenses. This is your insurance policy, right? This is supplies. You bought an insurance policy on August 31st, but that insurance policy does not come into play until September. So at the time you bought the insurance policy, it was an asset. It's an asset. So we're going to talk about the prepaid expenses. We're going to record the expense as the prepaid asset is consumed. Unearned revenues. This is the cash you receive before the services are performed. We are going to have an adjusting journal entry to record the actual revenues. And by the way, prepaid expenses and unearned revenues are the same thing. Let me repeat that. Prepaid expenses and unearned revenues are the same thing, depending on what side of the transaction you're on. Prepaid expenses, if you bought the insurance policy, you debited insurance and credited cash. If you're the insurance provider, you debited cash and credited unearned revenue, okay? So deferrals are one kind. The other are called accruals. Accruals. These are revenues for services we've performed, but not yet received in cash. Interest income is a good example. But most of your accrued entries are going to be accrued expenses. Expenses incurred, but not yet paid. The month ends, right? And we don't have the electric bill yet. Well, we're going to have to accrue that amount. We're going to have to estimate what our electric bill is and record that. Now they're showing you a trial balance here. And subsequent examples are based on this trial balance here. It's a nice looking trial balance. It adds up to 28,700. Timing. Below is a list of timing concepts in the last column with a description of the concept. There are more than match the description to the concept. Accrual, I'll go through these. Accrual-based accounting is when companies record transactions in the period when they occur. Calendar year, an accounting time frame that happens to be January 1st to December 31st. Periodicity, that's going to be C, where you can divide a business up into different areas. And the expense recognition principle, efforts should be matched with results. We're trying to match the revenues and expenses. Okay, let's have some fun with the deferrals. These are not that difficult once you do a couple, and more importantly, understand why we're doing them. If you understand why we're doing them, it makes the actual recording a little bit easier, okay? So let's see what we have here. We started off a couple of chapters ago. Where we analyzed transactions, we journalized them, we posted them in the last chapter, and now we're up to the trial balance, and we're ready to adjust that trial balance. Your deferrals are prepaid expenses and unearned revenue. They're the same exact thing. Prepaid expenses, payment of expenses that are recorded as an asset, show the service the company will receive in the future. So when we make the cash payment, it is an asset. It's the next month that part of it becomes an expense. Prepayments, you could have prepaid insurance, supplies, advertising. You could have a whole bunch of them. So take a look at your T account here. Here's your general ledger, right? Look at that asset. You purchased insurance, and that's sitting there as a debit, as an unadjusted balance, okay? You purchased an insurance policy for $12,000 in December. Now it's January. You are going to credit that asset to reduce it to $11,000 and debit an expense called insurance expense. Your adjusting journal entries, for the most part, are a search for unrecorded expenses, okay? And here's an illustration. An illustration. Let's see what we got here. Sierra Corporation purchased supplies costing $2,500 on October 5th, okay? So what did they do? They debited supplies and credited cash. So there's $2,500 of an asset that they purchased, okay? Now we come to the end, and the account shows a balance of $2,500 in the trial balance. But an inventory account was made at the end of the month, and it tells us that $1,000 worth of supplies are still on hand. So that means we used $1,500, okay? $1,500. We're going to debit supplies expense and credit supplies. In other words, we're reducing the asset every month and debiting an expense. So let's take a peek at it here. You have a basic analysis. We bought supplies for $2,500, and I'll bring your attention to the bottom of the page. We purchased supplies for $2,500 and credited cash. That was at the beginning of October. Now at the end of October, we realized that we used $1,500. So we're going to debit supplies expense to increase the supplies expense and credit the asset supplies. Make sense, Susie, so far? Susie's muted. Okay. Insurance. Here, they paid $600 for a policy for a year. So that's $50 a month. They bought the policy on October 4. and they debited insurance, prepaid insurance for 600 and credited cash. Now, at the end of the first month, they had insurance coverage, right? So that's an expense. They debit the expense and credit the prepaid. And again, let's take a look at the journal entry here. You debit insurance expense for 50 and you credit the asset. Look at the T accounts. You debit insurance expense for 50 and you credit prepaid insurance, okay? Let's talk about another one. This is an easier one, I think. Depreciation. Buildings, equipment, motor vehicles, the big ticket items that last a year are recorded as assets. They're going to give us benefits for many, many years, hopefully. Depreciation expense is the process of allocating the cost of the asset as an expense over its useful life. In other words, we buy a machine for $12,000 and we're going to depreciate it for 10 years. That's $1,200 per year depreciation, or $100 a month. Depreciation does not attempt to report the actual change in value. It has nothing to do with what the machine is really worth. It is an allocation concept, not a valuation. And that last sentence there, allocation concept, that pops up on the test once in a while. They ask true-false question. Let's talk about depreciation. Let's assume that the depreciation is $480 a year or $40 per month. This is your journal entry. Look at this journal entry. You are going to debit depreciation expense and you are going to credit accumulated depreciation to record depreciation. Accumulated depreciation is an asset account, okay? Accumulated depreciation is an asset account, but it's called a contra asset because it has a credit balance, normal credit balance. So the original cost of that asset, you're never going to touch. When you're doing a depreciation problem, you never credit the original cost of the asset. The only thing you credit is accumulated depreciation. That's why I say that this is an easy journal entry, because it's always the same. It's always a debit to depreciation expense and always a credit to accumulated depreciation. And we'll take another look at it here. The depreciation expense is debited, accumulated depreciation is credited. And here they're showing it in terms of the general ledger. So let's look at the general ledger. You purchased this equipment for $5,000, okay? You are never going to credit equipment. Never, unless you sell it. What you do have to record the depreciation expense. You do so with a debit to depreciation expense and a credit to accumulated depreciation. What you have reduced is called the net book value. $5,000, which is going to stay there forever, minus $40 means that the net book value is now $4,960. And that net book value is going to go lower and lower and lower until it goes down to zero. You're going to get to the point where the accumulated depreciation equals the original cost of the asset, and you're down to zero. Accumulated depreciation. It's a contra asset account. You're going to find a few contra accounts as we go through the chapters. A contra asset account with a normal credit balance offsets the related asset account on the balance sheet. Book value is the difference between the cost of any depreciable asset and its accumulated depreciation. The original cost of an asset minus the accumulated depreciation equals net book value. And here's an example. We paid $5,000 for the machine, less equipment, less depreciation expense. The accumulated depreciation is 40, and the net book value is 4,960. So let's take another look at the prepaid expenses. Examples: insurance, supplies, whatever. Prepaid expenses were originally recorded in asset accounts that are now being used. So that's why we have to adjust them. Before the adjustment, the asset would be overstated and the expenses would be understated. If you did not make these entries, you would have assets that are overstated that you don't have anymore and expenses understated that you haven't recorded. You're going to debit an expense and credit the asset. Debit the expense, credit the asset. Let's have some fun with unearned revenues. Unearned revenues. Here, we receive cash in advance of doing something. Okay? Unearned revenues often occurs in regard to rent, airline tickets, magazine subscriptions, tickets to baseball games if you pay in advance. So that's going to be recorded as a liability. We are going to debit cash. We're going to debit cash and credit the liability account called unearned revenue. And then at the end of the month, we're going to make this journal entry you see here. We debit the liability and we credit the revenue to increase it. So let's get an example going. Sierra Corporation received $1,200 in advance, really. Sierra Corp received $1,200 on October 2nd, from Arnox for advertising services expected to be completed by December 31st. So you've got that $1,200 sitting in the unearned service revenue account, which is a liability. We did $400 of the work in October, so we can claim $400 as real revenue. So look at your journal entry. We debit unearned revenue and we credit service revenue. We debit unearned revenue because we don't owe them $400 worth of work anymore. We did $400 and we credit service revenue. Here is the adjustment for unearned revenue. We debit 400 and that brings the balance down to 800, right? When we got the money, we credited unearned service revenue liability, debited cash. Now we did some of the work so we can reduce the liability with a debit and record the appropriate amount of income on this side, service revenue. Unearned revenue, they're giving you another little grid here, which I think is helpful. Unearned rent, magazines. You can think of a lot of things, concert tickets. Unearned revenues recorded in a liability account are now recognized as revenues as services are performed. The accounts before the adjustments, the liabilities are too high and the revenues understated. So we need to write that journal entry. The ledger of Hammond Inc. on March 31st, 2022 includes these selected amounts, okay? So let's take a peek here. Let's take a peek. Prepaid insurance is $3,600, supplies, etc. So we have 5 items there. Now it's the end of the month. An analysis of the account shows the following. Insurance expires at $100 per month. Supplies total $800. Our depreciation is $200, and they did $4,000 worth of that $9,200 work. Prepare the adjusting entries, okay? Prepare the adjusting entries. Maybe take out a piece of paper now and maybe even write it down. I'm going to have you write it down as we do them. Insurance expires at the end of the month. We know we're going to debit insurance expense to recognize the expense, and we're going to credit prepaid insurance. So take a look at that. Take a look at that. Are you following along, Camden? Makes sense? I'm going too fast? You debit insurance expense, you credit prepaid insurance. And now the insurance expense is recorded and the prepaid insurance goes down to $3,500. Supplies on hand totaled 800. But we put 2,800 up as an asset. 2,800 is how much we're showing in supplies. We only have 800. So that means we consume $2,000 worth of supplies. We debit supplies expense and we credit supplies. Okay. You following along, Susie? Everybody's locked up in their own world today. What was our third one? Equipment. Okay, this is the one that I say is the easiest to do because it's always the same. It's always a debit to depreciation expense and a credit to accumulated depreciation. When you credited accumulated depreciation, you reduced assets. You reduce the net book value. And then finally, services were performed for that $9,200. Someone paid us $9,200 in advance, and now we're doing the work. We did $4,000 worth of work. So this liability is not $9,200 anymore, it's $5,200. And here we go. We debit unearned revenue, the liability, and credit service revenue. Now, I'll stop here for just a moment. Adjusting journal entries are a little bit tricky. The key is to understand why we're doing them. We're searching for unrecorded expenses and maybe an unrecorded revenue or two. We're looking for unrecorded expenses that can only be done at month end. Every transaction that we've done so far up to this chapter has been with outside parties, right? We bought something, we sold something, we collected money, we paid money. Here, we're working strictly with internal people. These entries are not seen by the outside world. They don't involve anybody except us. We have to adjust our financial statements. Prepare accruals. Now, we said there were two types of adjusting entries, deferrals and accruals. The deferrals are your prepaid expenses and unearned revenue. And true or false, prepaid assets are the same thing as unearned revenue. True, 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 depending on what side of the transaction you are. Now we're going to talk about accruals. Accruals. Let me just back up to deferrals one more time. Here's a clue on deferrals. With a deferral, money changed hands. A deferral means money changed hands. It's the service that's deferred. With an adjusting entry, we've recorded, not recorded, but we've incurred the expense. We've earned the revenue, but we haven't recorded it yet. So let's take a look at accruals. Okay, we're still up to journalizing and posting journal entries, posting adjusting JEs, AJEs. Accrued revenues, revenues for services performed, but not yet received. This could be interest income. We loaned somebody money. We loaned them $10,000 at 12%. So they owe us $120 a year in interest, but they're not going to pay that interest until the beginning of the next year. We have to accrue that interest as revenue. So we're going to debit interest receivable, probably, and credit interest income. So let's see what we have here. Adjusting entry records the receivable that exists and the resulting revenue. So we have an asset going up. We're going to have a receivable going up and a revenue account going up. Sierra Corp performed services that were worth $200, and for some reason we didn't bill them to the client yet, okay? We have to accrue that. We earn that money. We haven't sent the bill out, which seems stupid, but we have to recognize that we did that work. So we're going to debit a receivable and credit a revenue account. Now we've recorded the sale, and I hope you understand that. We recorded this revenue. Now they receive the money, and that just means that we're going to take care of the receivable. Okay? You record the revenue when you earn it. It has nothing to do with when the cash comes. The asset accounts receivable is increased 200. This customer owes us $200. You debit $200 and you credit service revenue for 200. That's a misprint. They've got 400 there. Accounting for accrued revenues. Accrued revenues. We're talking interest, rent, services. The services were performed, but not yet received in cash or recorded. If we don't do these entries, your assets are understated, revenues are understated. So it's always going to be a debit to an asset, credit to revenues. Now, most of your accruals are going to be on the expense side, not the revenue side, because there's a lot more of them. Accrued expenses are often recognized for rent, interest, taxes. Salaries is a big one, and we're going to talk about that. Adjusting entries records the obligation and recognizes the expense. You increase an expense with a debit, you increase a liability account with a credit, okay? Sierra Corp signed a 3-year month payable, okay? We borrowed money for 3 months, and we have to pay back the money in 3 months along with the interest of 12% per year. Whenever you see the interest, though, that's 12% per year. This is only a 3-month note, so we're going to have to prorate that. So how much did we borrow? We borrowed $5,000 at 12%. You divide it by 12, you get $50 a month. So the interest when we pay it back is going to be 3 times 50. So for this particular month, we debit interest expense and we credit interest payable, okay? Because we borrowed the money on October 1st and the interest is 1% per month, we debit interest expense and we credit interest payable, all right? And we'll take another look at it here. Interest expense, debit, interest payable, credit. Accrued salaries, okay? Here we go. The start of the payroll is the 15th. It's every other Monday, right? And payday is until the 9th. So let's take a look at this. This company has paid all of its employees through October 26th. You see that? October 26th. But what happened? On October 29, 30, and 31, you worked. You guys worked. The business worked. You're not going to get paid for the 29th, 30th, and 31st until way out in November 9th. But when did you do the work? You did it in October. So that work that you did has to be monetized in October when you did it, not in November when you get paid. So that's an important thing to understand, and I think you do. You work the last 3 days of the month in October, you're not going to get paid for 2 more weeks. But because you worked it in October, that's where the expense belongs. So here we go. It turned out you earned $1,200. $1,200. You debit salaries and wages expense, and you credit accrued salaries and wages payable, okay? I hope I'm not going too fast. These adjustments can be a little tricky until you do a few of them. Remember, you're almost always going to be debiting an expense, okay? That's a good clue. Accrued expenses, interest, rent, salaries, utilities. It can be a lot of different things. Reason for the adjustment: expenses have been incurred but not yet paid in cash or recorded. Accounts before adjustment: expenses understated, liabilities understated. Adjusting entry: you debit expenses, you credit liabilities. So here's a summary. This is a good page. Maybe take a picture of this with your phone while you're doing your homework. Take a peek at this. Prepaid expenses. You're always going to debit an expense and credit a prepaid asset. You're always going to debit an expense and credit a prepaid asset. Depreciation's easy. That's depreciation expense, credit accumulated depreciation. Unearned revenues. You're going to debit the liability called unearned revenue and credit sales or revenues or services rendered, whatever you call them. Accrued revenue. Here's your interest. Your interest. Well, we can record the interest we earned this month, $50, whatever it was. We debit interest receivable, we credit interest revenue. And then the biggest one would be your accrued expenses, because you can have a lot of expenses. We talked about the accrued salaries. You could have accrued electric bill. At the end of the month, you don't have the electric bill yet. You don't know what the electricity expense is, but you're going to have to estimate a number and put that into the financial statements. Financial statements do have estimated numbers, and they must be done on what accounting calls a systematic and rational basis. Okay, let's do some accruals. Are you ready? Let's do some accruals together, okay? Micro Computer Services began operations August 1st, 2022. He started in the future. At the end of August 2022, management prepares financial statements. Okay, so let's see what we happen here. Oh, excuse me. I got a clunker here. Let's see. Oh, for heaven's sake. Okay. At August 31st, the company owed its employees $800 in salaries and wages. That's like the $1,200. So one of you worked a couple of days in August and you earned $800, but you're not getting paid until September. That expense must be accrued in the month of August. And we're going to do it with what type of an account? We're going to debit salaries expense and credit salaries payable. Here, we borrowed money. We borrowed money, a 15-year mortgage, but the annual rate is 10%. So we borrowed $30,000. 10% of 30,000 is 3,000. That comes to $250 a month. And then we have the unrecorded services we performed. So let's take a look. The company owed its employees $800. Thank you for working August 31st, everybody. That money gets recorded in August. You're not getting paid till September 15th. There is our journal entry. There is our journal entry. Debit to an expense, credit to payable. On August 1st, the company borrowed $30,000 from a local bank on a 15-year mortgage. The annual interest is 10%, $3,000 a year, divide by 12, $250. Even though we're not going to pay this annual interest until the end of the fiscal year, we have to recognize the expense. We have that expense, interest expense. Services performed but unrecorded. Here, we did some work for somebody, but we haven't billed them yet. We have to debit a receivable, credit service revenue. Debit a receivable, credit service revenue. The more likely one you're going to find is debit interest receivable and credit income and credit interest income. This computer of mine's acting up here. Okay, so that's a tough little section to get through, right? Adjusting journal entries. Now let's look at what happens after we do the adjusting journal entries. We have to adjust that trial balance, right? So now we're getting toward the end of our process here. We're getting near post-closing trial balance. Adjusted journal entries. We did the AJEs already. We already did the adjusting journal entries. Now it's time to adjust the trial balance and prepare the financial statements. So there is our adjusted trial balance. You see the red numbers? The red numbers? Those numbers were not there on the original trial balance. Now we are recording them. We're recording that $200 of work that we didn't bill out. We're recording the $1,000 of supplies and $550 of prepaid insurance expense. We're recording the expenses down here: supplies expense, salaries expense, rent expense, etc. So the red numbers are the numbers that came from or resulted from the adjusting journal entries. This is what I call the final trial balance, the adjusted trial balance. Now, how do we get from the old trial balance to the new one? Which of the following statement is wrong concerning an adjusted trial balance? Well, the adjusted trial balance lists the accounts segregated by assets and liabilities. They're not really segregated. They're just written in order. An adjusted trial balance, again, all it does is prove the equality of debits and credits. The adjusted trial balance is the primary basis for doing the financial statements. The trial balance is really a piece of scrap paper, and the adjusted trial balance is prepared after the entries have been journalized and posted. Preparing financial statements. Well, we should know, right, that we start with the income statement. We get the net income in order to move the net income into the retained earnings statement, and we get the new capital balance in the retained earnings statement to bring the ending retained earnings over to the balance sheet. So let's see what we have here. We start with the income statement. Now, you see where it says service revenue? Draw a horizontal line above service revenue when you get to a problem. Draw a horizontal line over service revenue. The reason for that is everything below that line is your income statement. Everything above that line is your balance sheet. Makes it a lot easier, huh? We're not going to give you a trial balance that's out of order. Some teachers like to do that, make it a little bit harder. But if you understand that your first revenue account starts the income statement, makes it a lot easier. So now that we know that everything below dividends in this example is our income statement, let's do the income statement. Sierra Corporation income statement for the month ended. Revenues, colon, what kind of revenues do they have? Service revenues, they call them, 10,600. What were the expenses? You just copy them right down from the trial balance. 52, 15, 900, 50, 50, 40. Total expenses were $7,740. Net income, $2,860. You okay with that, Susie? Okay. Looking good here. Now we're going to take the income statement and move it over to the retained earnings statement. Retained earnings statement. We have a beginning retained earnings of 0. This was a new business. Add net income, subtract dividends. That's all the retained earnings statement is. You start with the beginning retained earnings, add net income, subtract dividends. BIDE, beginning income, dividends ending. Bide your time. And we come up with a new retained earnings number of 2360. Now we're ready to do the balance sheet. The balance sheet. And all we have to do for the balance sheet is copy everything you see here over to the balance sheet with one exception. And what is that exception? The retained earnings. The retained earnings are now 2360. They didn't issue any more stock, so that's still 10,000. Retained earnings 2360. We don't show the dividends on the financial statements. Typically, you don't show them. And we're in balance here. So hopefully you get a feel now for why we do the net income first. Net income is done first in order to bring the net income down to the retained earnings statement, which is simply the beginning retained earnings plus income minus dividends. And then we just copy everything over you see here with the exception of the new retained earnings number of 2360. So that's a little bit of the flow there. Do it. Do it. Skolnick Corporation was organized on April 1st, 2022. The company prepares quarterly financial statements. The adjusted trial balance at June 30th is shown below. Okay. So they're giving you the trial balance, but they're not giving it to you in order. They're mixing it all up. Oh my goodness, they're making this so hard. So what they want you to do is take this trial balance and do something with it. The adjusted trial balance is shown below. What do they want us to do? Determine the net income for the quarter. How would we go about figuring out the net income from this thing? Net income is sales revenues minus expenses, right? So let's see if we can find some revenues here. I'm just running my finger down. I don't see any there. Aha. I see unearned revenue of 500. That's a liability, so that's not it. Our service revenue is $14,000. There's our revenue. 14,200 plus rent revenue. So we're going to start our income statement with service revenue 14,200, rent revenue 800. And I hope you're writing this down as we do it. So we have income statement, Skolnick Corporation, as of April 1st, as of June 30th, 2022. We start with service revenue, rent revenue. Now all we need to do is subtract the expenses. So let's just pick out all the expenses. Minus 9,400 for salaries and wages. We have rent expense, depreciation expense, supplies expense, utilities expense, and interest expense. So we have a half a dozen expenses. So it's simply 14,200 minus all those expenses. Net income, revenues. That's how we started it off, right? Now you just start listing all your expenses. And isn't that a nice, neat looking income statement? This company earned a profit of $2,490. Now we're ready to do the retained earnings statement. So let's take a look. Determine the total assets and total liabilities. Well, again, you're going to go back to this layout here. And you're going to add up all the assets and liabilities. Cash, asset, asset, asset. So they started you off with 4 assets. Do we have any more assets? Looks like they did clump them together for us pretty well. So it looks like we have those 5 assets there: cash, receivables, prepaid rent, supplies, and equipment. So we went through the income statement. Hopefully the income statement is not too tough. Now the total assets: cash, accounts receivable, prepaid rent, supplies, equipment. Let's see if there was any accumulated depreciation. And there was. Notice that goes in as a negative number because that decreases your assets. So assets are 23,350. Now they want the liabilities. Notes payable, accounts payable, and then we had unearned revenue. Liabilities are 7460. The difference between the two would be your equity, of course. Determine the amount of retained earnings at June 30th. Well, we had a beginning of 0. And maybe I shouldn't go back this much. That's okay. We had a beginning balance of 0. I'm sorry, guys. I'm floating around too much here. Retained earnings. At the beginning, it was 0. We did an income statement just now. It was 2490. Subtract dividends. They gave us the dividends a couple of slides ago. Look how easy the retained earnings statement is. Don't be afraid of it. It's simply the beginning balance plus income minus dividends. That's all there is to it. Beginning plus income minus dividends. Now that we have 1890 for retained earnings, we can do the they're skipping ahead here. They're not asking us to do the balance sheet, but we could have done the balance sheet at this point. You would have just copied all of those assets and liabilities we just did, and then plugged in the new retained earnings number. Now, this is a busy chapter, huh? We really got into some good stuff here. This is the chapter where maybe you need a little tutoring, possibly, or buddy up with someone else in the class. Buck up. This is a little tricky stuff. Now we're going to do what's called closing entries. Oh, yeah. You mean, Bob, we got adjusting entries, now closing entries? Yeah, closing entries. Closing entries. What we're going to do with closing entries is this. We are going to take every account in the income statement, every revenue, every expense, and we're going to zero them out. We are going to debit all the revenues. Revenues have a credit balance. Am I correct? Yes. Revenues have a credit balance. So we are going to debit the revenues and we are going to credit probably retained earnings. So we have two kinds of accounts, temporary and permanent. The balance sheet are the permanent accounts. You don't close those. They go on forever. The assets, liabilities, and equities are permanent. Nothing to do with closing entries. But the revenues, expenses, and dividends are temporary. They have to be zeroed out into retained earnings. So again, this is not difficult if you understand why we're doing it, what we're trying to accomplish. And what we're trying to accomplish is taking the net income and moving it into capital. In other words, it's going to look like the retained earnings statement. So let's see what they're doing here. Closing entries formally recognize the transfer of income to retained earnings and the owner's drawing to retained earnings. We want to have a zero balance in every account on the income statement. And they're journalized and posted at the very end of the accounting cycle. So here's what we're doing. Take a look at this. This is useful. We're going to take the revenues. We're going to debit all the revenue accounts. Now we don't have any more revenues. Zero. We're going to offset that entry with a credit to income summary and then moving into retained earnings. Same thing with the expenses. Expenses have a debit balance. So we're going to credit all of the expenses, move it into an account called income summary, and then into retained earnings. Income summary is a clearing account. It will never have a balance on your financial statements. It's just used to gather up the income from your income statement before moving it into retained earnings. Dividends can go right into retained earnings. So let's see what we're talking about. Service revenue. Revenues have a credit balance, correct? Revenues have a credit balance. How do we get rid of a credit balance? We do so with a debit. We debit service revenue. Now we have no more revenue. We zeroed it out. We credit income summary. And the explanation is to close the revenue account. Look what we do with the expenses, everybody. Look what we do with the expenses. We credit every single expense. Now we don't have any more expenses. We move it into the income summary account. So now the income summary account has 10,600 in revenue, 7,740 in expenses. In other words, it has the profit, right? It has the sales minus the expenses. That's our 2460 number, the profit. Retained earnings is now going to be updated. Let's go back here. 10,600 minus 7,740 is the net income of 2860. Okay? 2860. Now we're going to clear out that income summary account by moving it into retained earnings. So we zeroed out the income summary, moved it to retained earnings. The dividends are easy. You just move it to retained earnings. Now, I know this is tricky because you've not seen this before, and it might be still going to be a little bit murky. But let's see if we can look at it this way, okay? At the end of the month, here's our general ledger. There's the general ledger in green and purple here. Excuse me. General ledger. What were the revenues at the end of the month? $10,600. We have to zero it out. We debit it. So now this is zero. We credit income summary. So now income summary has the sales. How do we get rid of all the expenses? With a credit. We credit, we credit, we credit, we credit, we credit. We credit them out to get to a zero balance. These expenses add up to 7,740. So now at this point, we have the profit in there, and we have a balance sitting here of 2,860. Now we are ready to take that 2,860, zero it out from here, and move it into retained earnings. Okay? The dividends come over by themselves. Summary of the accounting cycle. Wow. Do you believe we went through the entire accounting cycle? We analyzed transactions. We journalize them. You learned how to write journal entries. We learned that you have to post them to the general ledger. Then we prepare a trial balance. And now number 5, journalize and post adjusting journal entries is what we started today. We do our adjusting entries. We prepare a post-closing trial balance. When we get the trial balance done, we have to do the closing entries. Now we can hand out the financial statements and prepare the final post-closing trial balance. It's quite a lot we covered today. Closing entries. Prepare the closing entries. Do you have a piece of paper in front of you? Why don't we try to do it? What do we close, first of all? We close only what's on the income statement. So we can ignore accounts payable. I see service revenue for $98,000. We're going to have to debit service revenue $98,000. I see rent expense, and I see salaries and wages expense, and I see supplies expense. Those have to be credited. So let's see what we have here. The service revenue, we debited service revenue to get rid of it. We now have to do the expense side. We're going to debit income summary, and we're going to credit. We're going to credit salaries and wages. We're going to credit rent. We're going to credit supplies. At that point, I think you would agree that the income summary account has the net income. So now we take that net income and move it over to retained earnings. There we go right there. we close the income into retained earnings. Dividends go directly to retained earnings. You don't need the income summary account. I'm going to keep plowing through this chapter because we're on the accelerated class, so we need to keep going. This I think is going to be the toughest chapter you guys find in the book until we get into some real world problems. So hopefully you can use me for tutoring, or any other teacher you might see on campus. If you're ever walking around the campus area, don't hesitate to grab a teacher if you see them in their office. If they have time, they'll be glad to help you out. Using a worksheet. Now we're going to come up with a big giant worksheet. 10 columns. We're going to start with the trial balance. So we're just copying the trial balance. This is a given. This is given. Remember the journal entries we just wrote, the adjusting journal entries? They're going to go into the second column here. So then we're able to come up with the correct trial balance. In other words, we're going to take the trial balance here on the worksheet, and we're going to take this number, add or subtract the adjusting number to get to the adjusted trial balance. At that point, we're able to prepare the income statement and the balance sheet. Okay? So let's divide and conquer as always. Oh my goodness, look at that worksheet. Good gosh, look at that. But again, we cut it down into bits and pieces. It's not that bad. Here's your trial balance. It's given, right? We've got this already. We already have this. Now we did adjusting journal entries. We found out that we had $1,500 of supplies expense, right? So we debit supplies expense and we credit supplies. That was journal entry A. Journal entry B. We recognize $50 worth of insurance expense. We debit insurance expense and we credit the asset prepaid. C, depreciation expense. We debit depreciation expense for $40 and we credit accumulated depreciation, which they omitted from this, it looks like. Is that possible? Jesus, another error. So you can see the first two columns are given. The next two columns, we put our journal entries. And it looks like we had A, B, C, D, E. We had 7 journal entries that we wrote. Now that we've written the journal entries, we can come up with the new trial balance. Cash, $15,200. Well, you never adjust cash. That comes over. Supplies, they were $2,500. Now we're crediting them $1,500. 1,000 is your new balance. Prepaid insurance, $600. They adjusted out $50. So I hope you get the understanding what we're doing here. We're taking the adjusted entries and we're minusing them or plussing them to the beginning to get the adjusted trial balance, okay? Once we've done that, and by the way, the hard part is the adjustments. These two columns here are the hard part. We get that done. Now we have to bring over everything to either the income statement or the balance sheet. Remember I said that Cornelia and I would never ever give you a trial balance that's out of order? Wiley does. Look what these bums did. They put accumulated depreciation down here with the expenses. That they shouldn't do that. The accumulated depreciation belongs right after the equipment. So what it means is my trick of putting a line above the service revenue doesn't work because they gave it to you out of order. So let's do the income statement first. What goes on the income statement? Revenues and expenses. Revenue, expenses, $52,900. Make sure you're pulling the number from the adjusted trial balance. It's very easy to make a mistake and go back to the beginning. No, we're done. These numbers are gone. Out with the old, in with the new. We've got $5,200 now in salaries and wage expense. We had 4 and we accrued another $1,200. Rent expense, $900, that didn't change. Expenses, We had no expenses at all. We had no expenses at all. Now we're recording them. 1,500, that's 1,500, etc. 40 is the outlier. That's the one they put in out of order. That belongs under the balance sheet, okay? So now we have our income statement done. There it is. 10,600 minus 7740 gives you the profit of 2860. Same thing over here. Same thing over here. If you did this correctly, if we did this correctly, we're going to be at a balance by the profit number on the debit side here, and on the credit side here with the balance sheet. We brought everything over. So does that make this spreadsheet a little less scary to put together? I hope it does. It's a little scary. The thing is, you got a beginning, they're giving you. You are the ones who are going to come up with the adjusting entries and then the trial balance. And once you have the trial balance, you move everything over to the income statement and balance sheet, and we're done. We are done. Okay, we're getting into IFRS, which we're not going to look at. Wow, boy, that was some chapter, huh? What do you think, Susie? You're mute. I can't hear you. You're muted. Susie doesn't want to speak out loud. We can't hear her. What do you think, Serena?
It was a lot.
It is a lot. Yeah, just do a little bit at a time. You know, going back, heading back to the beginning here. Let me control home. Yeah, just going back to the beginning, do a little bit at a time. You know, try to understand the accrual basis, why we're trying to do these things, and then worry about the accrual basis. Here's where you got to start putting your old thinking cap on. The adjusting entries. Why do we do adjusting entries? There are two types, deferrals and accruals. Get comfortable with the adjusting journal entries. Once you're a little more comfortable with the adjusting journal entries, then you'll be that much more comfortable posting them into the proper account. Okay. So it's just a matter of, again, I use the cliche, divide and conquer. Okay. Any other questions? Any other comments?
Is there tutoring later today at 4?
There is tutoring today at 4. I will be on campus in room BC 204, but I also will be live doing it on Zoom too. So
Okay, thank you.
anybody wants to come see me on campus, I really welcome the chance to say hi, okay? So we got tutoring at 4 to 7 today, okay? What do you think? I think it's time to close this meeting. This was a big class. This was the longest one I think we're ever going to have, okay? So I'm going to say, you guys all take it easy. Bye-bye. And there we go.